All right, so we're going to focus on 2.3 today, solving problems involving credit. And what you need to understand is, like I said, what line of credit means and what the Bank of Canada prime rate or the prime lending rate is. Okay, so if we take a look at investigate the math there in your textbook, right here. Okay, so this is your first page, 2.3. It says Liam wants to buy a carving by an Inuvialuit artist, Eli Nazaguluk, I think. He thinks it will cost about $3,900 and is considering two credit options. So the first thing he's considering is a line of credit, okay, which on your assignment you were asked to explain that, okay, in which has a limit of $10,000 but an interest rate of 2% compounded daily. Now, a line of credit, okay, is a pre-approved loan that offers immediate access to funds up to a predefined limit with a minimum monthly payment based on the accumulated interest. So the minimum payment is based upon how big, really, how much money you're taking out. A secure line of credit has a lower interest rate because it's guaranteed against the client's assets, usually property. So you have some kind of security there, some kind of collateral involved. Okay, so you can get money here right away. It's a little bit different than just using put it on your credit card. It's a line of credit. And usually the line of credit is quite a bit less of an interest rate than putting it on your credit card, which can be 15, 22%, right? Okay, so it's compounded daily. It's 2% above the Bank of Canada prime rate. Okay, so this 2% is above the prime rate, which in this case is 0.5%, let's say. So the Bank of Canada prime rate, or the prime lending rate, is a value set by Canada's central bank which other financial institutions use to set their interest rates. So it's basically, in your assignment, when you were looking for either a loan to buy a car or to make a mortgage payment or for student loans, you may have used the Bank of Canada prime lending rate as your percentage. Okay? It shouldn't have taken you too long to find out that online you're not going to get very far with finding an exact loan interest rate. You have to make an application, and that interest rate depends upon how much money you make, on how much debt you already have, all this sort of stuff. So that changes from person to person. So I'm not sure how you did your assignment, but on a lot of the calculators that you find online, it's already pre-populated. If you say I want to make a loan, take a loan out of my car. So that means the interest rate a lot of times shows up there. Or if you want to do a mortgage, the interest rate shows up there. So it's fine for you to use that one. Usually it's somewhere between 2.5% and 4.5%, something like that. I will accept various interest rates on that assignment. If you use the prime lending rate, that's fine. If you use the pre-populated already, anywhere between like the 2 and 4, that's fine. If you actually call down to a dealership, okay, which would have been, something that you probably, if you got nowhere online, then that would be the next step, calling the bank or calling a dealership, which is, part of getting the answers that you need. They would have told you that, hey, a lot of the car loans, if it's on a new car, you're going to get 1.9%, or you're going to get 3.9, or if it's a used car, you might get up to 7.9. So it depends. I wanted you to do some research and come up with, an appropriate interest percent. So you have to have, there's got to be some reasoning there. If you just said 30% or something like that, you're a little out to lunch, okay? But if you used any one of those, that's fine. This prime lending rate is basically an indication of how well the economy is doing, and it's sort of set by the main bank so that the economy can be kind of sort of kick-started, more people can put money into the economy and kind of pick things up, or if the people are spending too much money and things are too cheap, sometimes they raise the interest rates so that people will save a bit more, and they'll stop spending so much and getting so much debt. Okay, so it's sort of like the Bank of Canada is doing what they think is best for the country's economy, in that people have too much debt, so let's up the interest rates so that they don't borrow so much. Or our businesses are suffering and we need people to spend more money, so let's lower the cost of borrowing money so that people can inject that into businesses and spur the economy on a bit. Okay, And so the banks usually go, they're just a little bit above the prime rate. They're usually 0.5% or 2% or 1% or whatever it is above the prime rate. So in your assignment too, you should have investigated that this is what the prime rate is and what it means. Okay. So the second option here is a bank loan at 4%, compounded monthly to be repaid in one payment. So this is again what this whole section is about. It's going through different options, which yes, we've sort of done before, but we're kind of encompassing, special offers, rebates, now line of credit that has a different percentage, different rebates and all that sort of stuff. So we're kind of in this section, we're combining this sort of stuff. Okay. Just for sake of time, I want to go through example 1. Okay. In your textbook here, example 1. Let's take a look at this and let's work through this, and so you kind of get the idea of what it is we're doing. So Meryl and Kyle are buying furniture worth $1,075 on credit. They can make monthly payments of $75. Okay, as part of their budget. That's what they have to spend, and they have 2 credit options. Which option should they choose? Explain. So if you don't have enough cash to buy things like this, the other option is to do credit. And first option is the furniture store credit card, which is offering a $100 rebate off the purchase price and an interest rate of 18.7% compounded daily. So these are questions that you've done before. These are questions that you've done before. It's example 1. Right? Yeah. So these are questions that you've done before, and now we're basically comparing different types of options in one question. So the second option is a new bank credit card, which has an interest rate of 15.4% compounded daily, but no interest for the first year. So you have to sort of think about this, okay? In option B, no interest sounds really good, but are they going to be able to pay it all off within the year if they're only paying $75? Right? So you kind of have to do some calculations, and in this case, you'll have to find out how much money they're going to have left on the credit card at the end of the first year when the interest kicks in. So it's sort of, you got to consider the different options and do little pieces at a time. Of course, the graphing calculator, TVM Solver, is going to be very handy. You'll be able to use that, and as a matter of fact, I think they kind of walk through this. So let's get our calculators out. Let's walk through all this information, make sure that it makes sense to you, that you know what you're doing with the TVM Solver, okay? Because again, that's going to be huge. If you don't know how to use your graphing calculator, you're going to be hooked, okay, for the exam. Because there's a lot of this stuff that you're not going to be able to know how to do because we've been using it quite heavily. So we'll go through this one piece at a time. TVM Solver is Applications, Finance, and then there's TVM Solver. Okay? So present value is 1075 minus the 100. So present value here is 975. The payment amount is $75. Remember, we use a negative sign there, negative 75. To mean that's money that's being paid out, that's going away. You're short that money every month because of this, so it's going away, it's negative. Payment frequency is 12 times a year, so that's payments per year is 12. We got that already. Payments are made at the end of the payment period. Number of payments is unknown, so the number of payments is going to be unknown. So we're going to solve for this. Not sure what that was there. Okay, 18.7%. Let's do that. Okay. Compounding frequency, oh, there we go, 365, we've got that already. Future value, we want 0. Because it's compounded daily, it says. Compounded daily, right here. Okay? So does this look good? Is that everything that's from this question? We got that on there? Interest rate, present value, that's the money they borrowed, that's the payments every month, they want it to be completely paid off. Payments per year, that's 12, so it's 12 monthly payments, right? Yeah, and then, no, we took the 100 off the 1075. It's actually 1075 in the question. Right here, 1075. So we did take the 100 off to get 975. Okay? And so here you go, alpha solve 14.65. So down here, look at that. That's the same number that they got in the textbook, so that's good. So we filled everything in correctly. The number of monthly payments is 14.65 or 15. Okay, she's going to have to make 15 payments. All right, so does that make sense that we got that right? Okay. All right. Now, the total interest paid then, okay, is going to be 124. So where did this 124 come from? Now, okay, so they use a special application to find out this number directly. We don't have that application. Okay, so how do we find out the interest paid? Well, on your calculator, you know that it's 75 bucks and then times 15. So 75 times 15 minus 975. That's the original amount. That's the amount of interest. Okay. So just a note here, in this case, you do have to use the exact number of payments. Okay, now they say which is 15. It is 15 payments, but that last one wouldn't be 75. It would be whatever's left over at the very end. So this is the exact number of payments times $75. Okay, that's what we did here. Is this $1,099.05 minus the original price. That's the interest. Okay, so the total paid is $1,099. I think $1,099. We get 05 here. I must have rounded there. So $1,099.20 or now $1,099.05 is fine. Okay, that's the total amount right there, $1,099.05. So option B, if we go to option B, so you have that all written down. A new bank credit card which has an interest rate of 15.4% compounded daily, but no interest for the first year. So let's take a look at how this was broken down. Remember I said at the beginning, is she going to have it paid off by the end of the first year, or is there going to be some amount on there that's going to get charged interest? So the first year, I think we're pretty much guaranteed that it's going to be over a year, but 12 payments of $75 gives you 900 bucks. So that's a lot less than the purchase price, so you know it's going to be over a year. Right? Okay? So there was no interest to be had there. It's 75 times 12, 900 bucks. That goes directly to the principal. Now, this is what's left over. See, at the start of the second year, you have $175 left over. There's going to be interest on that now. The payments are still 75. The payment frequency is 12. The payments that are made at the end of the period, blah, blah, blah. Interest rate 15.4, compounded 365. So what we need to do then is we need to adjust, go back to our TVM solver. All right. And let's clear that. Let's change the interest to 15.4. Future value is still going to be 0. Okay, the present value, though, is only 175. It's 175 because the first year there's no interest, right? So,
So you take the 75 times by 12?
So yeah, so the first year you see there's no interest for the first year. So those payments of $75 every month goes straight towards the principal. So in that first year, paying 900 bucks, and so 1075 is the original amount minus the 900. You have $175 left over. So the first day of the second year, you have $175 now that they're going to charge you interest on that. Okay. So in our TVM solver, where were we? Our TVM solver, we put everything in. Does this look good? 15.4, 175. We want to solve for n. 2.38. Okay, so the number of payments we have left is this 2.384. Okay. So the total number of payments is going to be 15, blah, blah, blah. The total interest, so we go back to here and you say, okay, this number, this number right here times 75, that gives you the total number, the total amount that they paid in the second year. And then whatever that is above the 175 is the interest. Okay. Now I think if you want to use this exact number, you guys, let me see, where was this? Apps, finance.